Today on the Purpose-Based Retirement, tax diversification for your retirement accounts. Will Roth IRAs be around forever? And when will the bull market's gains be taken away by a subsequent bear market?
Welcome to the Purpose-Based Retirement with certified financial planner practitioner Casey Weade.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Casey leads a team of financial advisors with decades of experience helping families across the country retire with the confidence they deserve. The Purpose-Based Retirement assigns every dollar you've saved a specific purpose to meet a key retirement need.
Whatever risk you faced, we've got a plan for that.
Stay tuned and learn how you can look forward to a worry-free, purpose-based retirement.
Good to see you again. Thanks for joining us. I'm Lee Kelso here with Casey Weade, certified financial planner and the president of Howard Bailey Financial. We're going to start the program today talking a little bit about taxes in retirement, a very important topic that's difficult to escape, and it comes from one of your favorite websites, NerdWallet.
Yeah, NerdWallet. I just have a blast on NerdWallet. anytime that I'm looking to dig into a little something, it seems like they always have an article that appeals to me. And every single week, I put out a handful of articles, 4 articles every Friday, called Weekend Reading for Retirees. And I'll handpick 4 articles, offer my little thought on that article itself, a little blurb, and then offer them some education regarding whatever topic that might be. It can cover everything from, we've had articles on healthcare sharing programs that was really popular, on Roth conversion strategies, life insurance strategies, long-term care options. There's so much for a retiree to really understand in the world that we live in today before they step into permanent unemployment, that it's so great that we can constantly provide that education, because Google can be a very overwhelming place. And if we can provide you with the most impactful articles time and time again, I think that's a great thing. So if you'd like to sign up for our Weekend Reading for Retirees, just shoot us an email at info@howardbailey.com. That's info@howardbailey.com. We will set you up with our past articles if you like, and we'll definitely set you up on an ongoing basis.
Excellent. So, tax diversification in retirement. Most people think I'm in retirement, taxes are really nothing I need to worry about. I mean, my income is down, so what's the problem?
Yeah, well, I think most of the people that walk into our office, they have everything tied up in IRAs and 401ks, and they now run themselves into a situation where they have the biggest liability that they weren't even aware of. Maybe they already paid off their mortgage, and they said, ooh, I'm debt-free. Well, the reality is you've got debt on your IRAs, on your 401ks, because they've never been taxed, and that debt is owed to Uncle Sam. And we quite often say you've got a partnership with Uncle Sam, and we need to figure out how to break that partnership off. Yeah. And most people, what they need to be focusing on is creating tax diversification so they have more options as they make that step into retirement. And that's what the NerdWallet article was really all about. It was about tax diversification. You diversify your investments, and that's talked about by financial advisors all the time because they get paid to diversify your investments. They don't get paid to diversify your tax buckets. And that's why I love this article, because it finally offers you an article that shares with you why tax diversification is so important, the different types of taxation that you're going to see on those different tax buckets, and offers up specific strategies for you to actually implement as you begin to take withdrawals from those accounts, which most often is never even discussed. It's just, hey, you need $50,000, just take a distribution and everything will be okay. It's more complex than that if we're worried about our dollars and cents. It's not how much money we make, it's ultimately about how much money you keep, and that comes down to tax planning.
Yeah, so what do I need to understand about that withdrawal strategy?
Yeah, well, I think there's a lot of different ways that we can do this, but I think the starting point is really just understanding the different types of buckets that are out there. And you really have 3 in general. And most people, unfortunately, only have 1. They have their IRAs and 401ks. They have their tax-deferred funds. Now, your tax-deferred funds, when you start taking distributions from your IRAs, from your 401ks, from your 403bs, 457s, that alphabet soup of tax deferral, ultimately, those are going to be taxed at ordinary income tax rates, your highest marginal tax bracket throughout retirement. Under current tax law, that could be 10 to 37%. But those tax rates are set to expire by 2025, maybe by the time you step into retirement, and they go back to 15% to 39.6%. So that's the first place that most people start, is those 401ks and IRAs. And then the next place is your non-qualified funds. So these are after-tax funds that we've already paid taxes on. I like to call these 1099 money, and also I'm telling on you forms. So every single year you get an I'm telling on you form. That's a 1099 for your CDs, your mutual funds, things at the bank, that are kicking out income for you when you're not even spending it. I had a gentleman that I worked with here recently that said, I file my taxes every year and I just go ahead and pay the taxes. I'm really not sure what I could do, but take a look at it. Well, we found $50,000 in 1099 interest from CDs that were being kicked out every single year unnecessarily. It was costing him more in Social Security taxes, and it was pushing him into the next tax bracket from 12% to 22%. If we just tax sheltered that ongoing income, now that popped him back in the 12% bracket. It was huge to him, and it was a huge impact. Yeah. This is why those non-qualified funds, if you have them, make sure you're not paying taxes on them every single year if you're not spending them. Warren Buffett once said, we never spend money on money we're not spending. Think about that for a minute. Right. That's what you're doing if you're getting those 1099s and you're leaving the money alone. You're paying taxes on it and you're not taking a distribution. Now, everybody wants the third type of account, which is tax-free. Right? Tax deferred's good, taxable, not so exciting. Tax-free, everybody loves tax-free, but there are very few places you can go for truly tax-free income. Roth IRA is one of those places. So most people that walk in have a little tiny Roth IRA. They don't have a lot in Roth IRAs because it just felt really good to have that instant gratification during their working years and get that tax deduction so they could go on their vacation and get that money back when they filed their taxes. But once you step into retirement, boy, that Roth IRA is the dream account that gives you that tax-free income for the rest of your life. And what we want to do is we want to utilize all three of these different accounts, if possible, to create a diversified income strategy and minimize your taxes or manage your taxes.
So give me an example of how that works in real life.
Sure. Well, let's go with a very simple example. Maybe we'll have a chance to step into some more sophisticated ones. But if we just say, well, let's say you step into retirement, you've got Social Security and pension income, and then you need an extra $50,000 in income in order to meet your spending needs. So where do you get that $50,000? Well, maybe the first place we go is your 401k. Those tax-deferred accounts that are going to be taxed at ordinary income rates, we take just enough out of those IRAs or 401ks to get you to the top of that tax bracket. Okay, maybe you're just getting to the top of the 12% bracket. That happens at about $80,000 in income. Actually, more than that if we count standard deduction. So first, we're going to take distributions from those 401ks. The next place we might go is stepping into those non-qualified funds. And those non-qualified funds, if they're held for more than 1 year, then they're going to be taxed at 0, 15%, 20%, maybe even 23.8% if we hit the dreaded Medicare surtax at about $250,000 in income. But that can give us a place that you might actually not pay any taxes on those non-qualified funds as long as you stay in the 12% bracket today or lower. Then you're not going to pay any taxes on those gains. Then you might go to your Roth IRA to fill in the gap. Once you hit the top of that bracket, you say, I really don't want to go in the 22% bracket. Why don't I take a distribution from my Roth IRA just enough to get me to where I want to be? So it's blending those different buckets to manage your taxable income.
So I need to turn to somebody like you who really understands that well. So that's one of the things you do is help me plan for those withdrawals?
Yeah, and that's, I think CPAs really enjoy working with us because we do a lot of the heavy lifting and we say, we've already done the projections, we've already done the planning, now we just need you to sign off and approve it and tell us if we missed anything. It's great to have that team around you, someone to do the planning and someone to check the law and make sure that everything's working in the right direction. And it's so important to do that diversification because you might say today, yes, I'm going to be in a lower tax bracket when I get into retirement, but that may just not be the case. No one has a crystal ball regarding government regulations. They like to change their mind. Things that have happened in the past tend to happen in the future, and this is why we want to have flexibility when that time comes. There's a couple that I worked with recently, if I could share just a couple of quick examples. I've got a couple that retired at age 60 and they had a 10-year pension payout. So they're going to get enough income to cover all their expenses for the next 10 years from their pension. And during that 10-year period, we're going to convert all of their traditional IRAs to Roth IRAs. By the time they get to 70, they'll have maxed out their Social Security benefit. They'll have everything in tax-free retirement accounts. They'll have a tax-free retirement. They'll never pay Social Security taxes on any of that income because the rest of their withdrawals will come from Roth IRAs. that's just one of the many strategies that we'll use. I had another couple that we recently implemented a strategy for that had a lot of after-tax funds because they owned a business. And business owners typically end up with a lot of after-tax money because they met a lot of the maximum contribution limits on a lot of their qualified accounts. So they ended up with all this after-tax funds. And so what we ended up doing is we're going to take a small distribution from the IRA every year along with our Social Security, and then we're going to take a lot of the non-qualified funds, set them aside in our tax-efficient, low-cost ETF portfolio, largely generating long-term capital gains every year, and move some of those non-qualified funds into Roth IRAs and other tax-free income strategies, so by the time they get to 70, they're tax-free. Those are the things we do at Howard Bailey.
That's pretty exciting stuff. And you know, it's so complex. My guess is that you're probably not managing that well yourself in that regard. So here is an opportunity I hope you'll take advantage of and be one of the next 10 people to jump on the phone right now and call the number on your screen and ask for a complimentary review of what's going on in your retirement planning. Are there tax strategies you could be implementing that could save you lots of money down the road? My guess is that there are. You'll cover that and many other things as you sit down with Casey or another member of the Howard Bailey team. So I hope you're one of the next 10 people to jump on the phone right now and request that complimentary review of exactly what's happening in your retirement plan and whether or not you are headed for a successful retirement. Call that number now and get on the calendar, okay? All right, when we come back, we have questions from our viewers. We'll be answering questions from viewers just like you.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
Let me help you create the retirement you dream of. Go to my website and pick one of 3 education options to get started today. Get a copy of one of my retirement planning books, sign up for a Purpose-Based Retirement live event, or go to the Purpose-Based Retirement University. 2 days of college-level retirement planning instruction. With the right education and proper coaching, I believe anyone can create the retirement they dream of. It all begins with one step. Visit thepurposebasedretirement.com.
It's the time of the program where we answer your questions. During the week, people send emails to Casey at info@howardbailey.com. We pick out a few of those questions, then invite those people to join us on the program. And that's what we've done with Max in South Bend. Max?
What are the benefits to giving my money away before dying?
There's actually quite a few benefits to giving those funds away prior to death. However, always exercise caution here. If you might need those funds in the future, you probably don't want to give them away yet. But there are some things to think about, especially today. You know, if you have a very large estate today, because we've seen this expansion in the estate tax exemption, you might want to start utilizing some of those today to avoid estate taxes that might come back and rear their ugly head in the future. So historically, we've seen $1 million estate tax exemptions, and most recently, prior to tax reform, we had about a $10 million estate tax exemption. Now it's going to $22 million. So today you could give away $10 million, which used to be taxed heavily upon death, given estate taxes, and now you could give away that $10 million, and then when the exemption goes back in 2025, as it's slated to, unless it's made permanent, then you've already given those funds away. And the argument is, when we talk to our attorney and our legal partners, they say that you've already given away those funds under what the law was at that time. They can't revoke those benefits at a later time, even if that tax law expires. So that's one of the unique things that we have going on in our environment right now. Other reasons you might want to do that is, let's say you're charitably inclined. Well, if you have funds that you plan to pass on to charity when you pass away, then ultimately they'll pass on to charity and you won't have any taxes on those assets, but really they wouldn't have been taxed most likely anyways. However, you're not getting any tax benefit out of those funds either. Right now, you're probably paying some taxes. You're probably paying some federal taxes, some state taxes, where if you gave those funds away today, now you could get a deduction that you could use against maybe IRA distributions, you could use against maybe pension, your Social Security, you could use it to reduce some of the taxes you're paying today because you've given those funds away. And let's say that you're not ready to completely give up control of the funds. Well, maybe you want to set up a charitable remainder trust. We did this for, we've done quite a few of these, and one here most recently for a gentleman who is highly concentrated in one individual stock position that made him very uncomfortable. They had about 80% of their wealth in one stock, and they knew that that could completely set them off course if that company did not perform. But they were afraid of the tax ramifications if they sold it. So we were able to move those funds into a charitable remainder trust, re-diversify without the tax consequences, get a tax deduction that we could use today, and have income for the rest of our lives. So there's a lot of reasons that you might want to think about starting to give away funds today rather than when you pass away, and you just have to sit down and review all those different reasons and find the one that's right for you.
All right, thanks, Max, for that question. Let's get to Terry and her question about CDs.
Do certificates of deposit still serve a purpose in today's low interest rate environment?
Well, Terry, I know that probably doesn't feel like they serve their purpose because you're only getting maybe 1 or 2% today, maybe as high as 2.5%. If you're really lucky, you've got a 3% CD for maybe 5 or 10 years. But they still serve their purpose. I think if we think of the different worlds of investing, we have the world of safety and guarantees. We've got a fixed rate of return for a fixed period. Maybe this is money markets, savings accounts, even CDs, I believe, fall into that category as long as you pay attention to the penalties. Typically, it's only, say, 3 to 6 month interest penalties. Then you have the world of risk. Then you have stocks and bonds and mutual funds. You hope to make a higher rate of return, but you're willing to take on some risk for that. You've got the middle world that provides you principal protection and upside potential. You've got a rate of return in the middle, but you've got more strings attached to the money. The banker wants all your money here. The insurance guy wants all your money here. And the broker wants you to keep all your money in the market. Market always goes up. It never goes down. Just sit on your hands. The reality is they're all right in their own right, as long as we find the right purpose for those dollars. A CD can serve a purpose as an extended emergency fund. Maybe you've got 3 months of expenses in a savings account, and you've got 6 months or 2 years of savings in a CD, where you have a minimal penalty in order to take those funds out. These are the types of things that you want to think about as you're going through your planning, recognizing all the different types of assets that are out there and what the specific purpose is for your dollars that you've worked so hard to save.
And we're jumping over to Warsaw, and James, his question's about Roths.
You often recommend Roth IRAs, but how do you know the government won't revoke all these incredible benefits in the future?
James, I don't know that they're not going to revoke or change the benefits in the future. And this is why we always talk about tax diversification. Having multiple places that we can go in case rules do change down the road, in case taxes do change down the road. Let's have some IRA funds. Tax deferred. Let's have some maybe non-qualified tax sheltered accounts. Let's have some Roth IRAs. Let's have some cash value tax-free life insurance. Let's have some non-qualified funds that are taxed at, say, capital gains rates. Let's have all these different places so we can have flexibility as we step into retirement, because I don't know what's going to happen. However, there have been changes made in the past. I think this is a question that akens itself to Social Security not being there at some point in the future, or having major changes to Social Security at some point in the future. Sure, there'll be major changes. There's been major changes made to Social Security since its inception. They've happened time and time again, but they've always been sunsetted provisions. We've always seen those things sunsetted for individuals that are typically around their mid-50s, and if there are changes to Roth IRAs, you're going to see those things get sunsetted. Think about who uses Roth IRAs. It's typically middle to middle upper class individuals that have a lot of funds that they can pay to get the right person in Congress, right person in the White House that's going to allow them to retain the tax-free benefits of those Roth IRAs. If you're not doing it at all, then you're just not taking advantage of a benefit that you could have. You have to take advantage of all the different opportunities that you have. And Roth IRAs, there's never been a better time to own a Roth IRA than now, given what's happened with tax reform. Make sure you stay diversified, not just in your investments, but in your tax buckets as well.
Thanks for all those good questions. And if you have questions about what's going on in your financial world, I hope you're one of the next 10 people to jump on the line and request a complimentary review of exactly what's happening in your retirement plan. Are there advantages that you might not be capturing just now? Well, one way to find out is to be one of the next 10 callers to request a meeting with Casey or a member of the Howard Bailey team to review exactly what your financial plan looks like and whether or not you're headed toward a successful retirement. Get on the phone right now and be one of the next 10 people to call. I think it's going to be worth your time. All right, our question of the day now has to do with the market losses after the deep recession, the Great Recession. From 1929 to 1932, how much did the market lose? The answer when we come back.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshall Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
So going into the break, we asked you our question of the day. Here it is. What was the market loss from 1929 to 1932? Casey, I know it's a big number, but how big?
It is a big number, and typically those big numbers are easy to forget when they're that long ago, and the answer is actually D, 86%. So that means if you had $1 million invested in the stock market in 1929, by the time we got to 1932, there was only $140,000 left of your original $1 million, and it took you 25 years just to get back to even. If we look at 2008's financial crisis, that might be a not so distant memory. However, we would have seen $1 million turn into about $500,000, maybe even $400,000 over that period of time, take years to get back to even. After the 2000 market crash, it took the average investor 14 years on an inflation-adjusted basis just to get back to even. And now we find ourselves in a place again where the market seems to be becoming overheated. It seems to be getting more expensive because we've been in one of the longest bull markets in history, and the markets ebb and flow. They have bull markets and they have bear markets. And typically what happens is we see the bear market pull away a majority of the gains that you saw in the previous bull market that most people want to talk about. Most financial advisors, most brokers just want to share with you how well the market's done over the last couple of years. But if we look at the reality, if we look at the bull markets and then the subsequent bear markets that always follow, we can see after 2007, all of the gains were washed away by the subsequent bear market that came out of the previous bull market. The same thing in 73, 69, down here in 46, 38, almost in 37, we saw all of the gains from the previous bull market washed away by a subsequent bear market. And we can even see after 2000, 1990, 1987, 1980, about 50% of the previous bull market gains were washed away by the subsequent bear market. So what's this look like on a point basis? And I think this chart really puts it in a way that we can really understand when we look at the points in the market, from the bull markets being these blue shaded areas to the bear markets being these orange shaded areas. We can see what inflation adjusted point gains and losses have actually looked like over time. Typically, all you hear is the market averages 10% a year, or the market just continues to rise over time. Just sit on your hands. But if we look at one of the oldest bear markets on recorded history, we see in the early 1900s down 180 points, and then we see in the early 20s and mid 20s leading up to the 1929 Great Depression, we saw a 352-point gain followed by a 352-point loss. Then we had a 200-point gain, a 190 loss, a 120 gain, a 97-point loss. Then we had a 580-point gain and a 450-point subsequent loss in the following bear market. And then we get to where most baby boomers made the majority of their life savings, which was in those 80s and 90s, the peak of the baby boomers' earning years. And now they're taking money directly out of their paycheck and injecting it straight into the stock market. You know, on another note, this is also where most financial advisors and stockbrokers got their start as well, with the average age of a financial advisor being about 59 years old. We find that many of them have that mentality that we always see the market go up. However, Even following the biggest bull market in history, the subsequent loss was about 970 points after that 1,800-point gain. And then we had the point leading up to 2007, a 675-point gain, a 920-point loss, and now we find ourselves sitting here today at about a 1,500-point gain. What's the next bear market going to look like? Well, one of the ways that you can protect yourself, which is so often discussed, is to be diversified and have more than just holding the S&P 500, which is what is so often talked about in the media. But there's many other asset classes that you can hold in order to create a truly diversified allocation and smooth those returns out over time. If everything you currently have is in one stock, is in a group of mutual funds, is in the S&P 500, large cap equities, you might want to think about rediversifying for the subsequent bear market that is soon to follow. We can see this yellow line shares with you what the bond market has done year after year going back to 1998 through 2017. Right now you might say, I'm getting out of bonds because they've performed so poorly over the last couple of years. But if we have a bad market next year, that might be the exact place that you want to be. If we look at U.S. large cap stocks, the S&P 500, this white line shares with us that it hasn't always been on top. It's been quite often in the middle. Sometimes it's been second best. And if we look at emerging markets, quite often on the top, but also quite often on the bottom. And this is why we want to diversify as you step into retirement, and not just diversify, but have a strategy for where we can get that income from if the market's down. Most advisors may diversify you. However, when the market pulls back, you have to have a plan for which one of those asset classes you're going to go to in order to satisfy your income needs while you wait for the other portion of your portfolio to rebound. Now let's take a look at the reality. Most brokers only want to talk about the last few years. However, if we go all the way back to 2000 through the end of 2018, the market's averaged an annual compound rate of return just shy of 3% per year. So where's that 6% or 10% that's so often discussed? Well, those major losses quite often rip those things right out of our hands. We would have been better getting 50% of the market's gains and none of the losses over the last 20 years, or even investing in a CD paying us 3 or 4% per year and getting rid of the stress of this market roller coaster. So ask yourself these questions. One, do you have enough? Maybe you find yourself approaching retirement and saying, I've had some great gains. Do I have enough that I don't need to take this risk anymore? Do you have a bear market strategy? Are you already in retirement where if the market pulls back, you have a place to go to satisfy your income needs, satisfy your emergencies, satisfy your healthcare issues that may arise when the market's down? And where will you be the next time around that we see a bear market repo all of the bull market's gains we've seen previously? Are you 20 years out from retirement? Maybe it's not a concern. Are you 5 years out from retirement and you need some gains? Are you 5 years into retirement and you don't want to be put back to work? Ask yourselves these questions and make sure you're putting together a strategy that can prepare you for both the best and the worst.
Boy, that is so true. You know, really struck me when you talked about the fact that so many brokers have never been through this kind of a wild correction.
Right.
Well, that leaves a lot of people at risk.
And they find people like me that got started during the financial crisis. And that leads us to what's often known as a Great Recession generation. We have that fear that the Great Depression generation had, and they called the Great Depression generation the greatest generation.
Right. So if you're not sure exactly where you're at and what might be happening in your portfolio, I hope you're one of the next 10 people to jump on the phone and request a complimentary review of exactly what's happening in your financial life. Are you positioned with too much risk for that potential repo market that could be coming our way? What's going to happen to your monthly income during that time? These are all factors you can discuss when you sit down with Casey or a member of the Howard Bailey team and learn more about what's going on in your situation and how you can best be positioned for a successful retirement. So I hope you'll be one of the next 10 people to call right now and ask for that complimentary review. You can always drop by thepurposebasedretirement.com. There you can order a copy of one of Casey's books. You can schedule an appointment or find out about some events that are upcoming where you can learn more about what Howard Bailey can do for you and make sure that you're positioned for a purpose-based retirement. We'll see you next week.